It's finding the right relationship. When the shit hits the fan, can I sit down with them and go, look, let's work together?
Welcome to the Stamford Finance Podcast, where we explore what it really takes to build a business as a lender and the lessons you only learn once you're in the market.
We've made a few mistakes, haven't we? They've been painful. We've had some great ones that have more than compensated for that, but you live and learn.
What makes a new lender succeed in a competitive market? We've kissed a couple of frogs. We've had some horrible interactions. It's not all plain sailing.
You've just got to put yourself out there and find those good deals, because you can find bad ones pretty easily.
I'm Pete Beaumont, and today I'm joined by Stamford Finance CEO Stuart Fraser and Glenhawk and Fortaker founder Guy Harrington. If you've ever wondered what separates lenders that scale from those that stall, this episode is for you. Guy, Stuart, thank you very much for joining me.
Thanks for having us.
Yeah, good to be back, Pete.
Oh, good to be alongside you. Guy, would you mind if we started very briefly talking about Glenhawk? It was a pretty big business, and it still is a pretty big business. Was it exactly what you thought it was going to be at its inception?
Yeah, really good question. Completely different, I think. I never really imagined getting it to the scale we got it to. I went into it not really having a number in mind. I guess it was, month to month, year to year, rolling, and then suddenly you hit the milestones and you go, oh, I'm not happy with that. I want a bit more. And you go, I want a bit bigger. I want a bigger number. And you just go and go and go. And I guess at the start there, you're always thinking, 100 million loan books are a great size to get to, just because it's a huge amount of money. It's like a Euro Millions style number. And then, you reach that point and then you just keep going and going. But with that, the business evolves, the team grows, the funding changes, and the people change as well. But it eventually got to a size where, hence why I did step down in the end, it was almost too big for me and the volumes it was doing. And my enjoyment was, it was a great business, but sometimes you want to get your teeth stuck into something else once you've done it once.
Yeah. And what sort of quantum are we talking at that point?
So we lent just over now about 3 billion into the market, with an average loan size of it swung between 500,000 and 750,000 on each loan, depending on the market and where we were geographically putting a lot of the loans. And then in terms of like live loan book, I think we got it to is about 600 million. So it was a sizable book with a lot of funding and a lot of complexities. But in terms of our best month, I think we did 56 million in 1 month was our best back in June 2023 or 2024, I think it was. And that was just chaos, like absolute chaos. Running around chasing lawyers, valuers, and the team were working incredibly hard, amazing people. But some good memories from those days.
Oh, I bet. And did you know exactly what you were stepping into in terms of governance? AML, KYC, all of the bits that go alongside lending or hand in hand. Did you have a really good understanding of that before you started, or?
Not really, no. Quite frankly, I didn't really fully understand finance businesses at all. I was terrible at maths at school. Still not the best, but you learn on the job, and you have to adapt, and then everything else comes with it, I guess. So, to get a business going, clearly you need people. People are, 90% of the business. Without them, you can't grow it, you can't build it. And then all the other ancillary things that go along with that. And back in the day when we started it, unregulated lending was, just that. It was, not a regulated mortgage product, not advised. It was very straightforward. And the KYC AML was always on the lawyers and on the client side. And then slowly over the last, I guess, 5-6 years, certainly with recent events in the market, you've seen more and more of that creeping in. So I guess at the start it was, we weren't really exposed to it as much as non-bank lenders are now, and regulated lenders. We were almost, merged into it slowly. We always operated like a regulated entity, I think, is the best way to approach it, which I'd say for any business operating in this environment at the moment, when regulation can change very quickly, act like you're regulated even though you're not.
Yeah, of course.
Yeah, that's a very good point. And it's probably a bit of the journey that that you've been on, Stuart, was it all you thought it was going to be? Is it more complicated, easier? What's your views?
Look, I think resonate with a lot of what Guy's touched on there. I got into it with yourself, Pete. I didn't have the experience in the sector. You did, thankfully. Thankfully, one of us did. And we're at 100-ish million now, give or take, and that was probably our initial aspiration. But you get there, actually, I quite enjoy this. I think if we push on, we could be a bit more efficient. We could spread our overhead wiser. You look at technology, and we were having a pre-chat earlier about AI, which I'm sure we'll come on to, and you look at the process and procedure we go through. You know, we've made some mistakes. With hindsight, you look back over a 4-year journey and we'll learn from this, we'll learn from that. We won't do that again. Let's do loads of these because they're brilliant. And you try and take all that learning and technology and evolution and build it into your business for the journey that will hopefully take us from 100 to 200, which is the next target. And then we'll take stock. We're never going to go to a Glenhawk size, far from it. But yeah, I think, you know, resonate with a lot of it. You know, we've made a few mistakes, haven't we? They've been painful. We've had some great ones that have more than compensated for that. But you know, you live and learn. And I think that's the excitement of starting and growing a business, isn't it? You know, for want of a better description, you are winging it a little bit.
Yeah.
But if you're determined and you're driven, and you have controls and you have governance without becoming bureaucratic, it's amazing what you can achieve if you've got the right people.
Yeah, completely. Yeah, the winging it piece is really interesting because you don't really know unless you try.
No.
And I was watching a really good, I think it was a podcast the other day about doctors and how they become a doctor and when they first do their first operation. And it's like the building up to it. Like, do you train for 50 years to do it, or at some point do you just have to do it?
Yeah, you've got to cut loose.
Yeah, you have to do it,
go.
have to practice and give it a go, and someone has to learn on the job as such.
No, I think well put.
Yeah, and I mean, it's no secret. It's fairly publicly documented your success in other ventures as well. Was it the same ethos at that point where you just had to go alone? You just had to do something different?
Exactly the same. Yeah, I think the difference being, you know, I left uni, took a summer job in the utility sector. Was never my intention to remain there, but I did. Ended up working for a company for 10 years, salary PAYE'd, a bit of bonus, a little bit of equity eventually, but what a grounding that, and you know, it allowed me to develop my experience and my knowledge. But then if you've got that entrepreneurial spirit, you're looking at what other people achieved. There was a couple of trailblazers in our industry, one of which who remains a good friend now, a guy called Owen McLaughlin, who you look at what they achieved and think, well, you know what, I'm going to have a go at that. I could do that. He's better than me here, but I'm probably better at this than him. What's the worst thing that can happen? I have a go. It doesn't work out. Yeah. I'll always get a job somewhere because you treat people well, you work hard, you try and make sure your brand is good and positive in the space, and you'll make mistakes. And I think where Dan and I, my ex-business partner, were good together was, well, look, we'll have a go. If it doesn't work out, we'll have a plan B. And if plan B doesn't work, well, guess what? There'll be a plan C, and we'll find a way through that challenge one way or the other. So yeah, it absolutely resonates, because sometimes you'll have your ups and downs. It's an emotional journey, as I'm sure you know, and there'll be some great days. There's some hellishly lonely days as well when it's not going well, but you'll find a way. But I think the point Guy made at the start, without reiterating it too much, it's spotting those people on that journey and saying, wow, she's good, or he's great at that. I need that in my business, particularly where you know it's your weakness. Get those complementary skills around you. Get people who are strong enough to say, Guy, that's not right. I know you want to do it for these reasons, but I've seen it done here. I think we should do this. And you're obviously, because you won't have got that business to that size without being wired like this, you're mature enough to say, you're right, I was wrong there, so you've saved me making a mistake, but we'll go with that, and they're everything.
I mean, they can be very expensive mistakes in our space as well, can't they?
Well, so we've got that T-shirt, Pete.
I've taken it off for today. And Guy, was Glenhawk your first solo venture, or have you done a few other bits in the meantime?
Yeah, a few bits really. I mean, I had quite a varied career, ranging from trading mobile phones when I was at university, and back then it was the Nokia 8210s, Matrix phones, all the in-trend pieces. And I used to go out of Sheffield Uni, go to a mobile phone shop in Chesterfield called Kalin Mobile Communications. I don't know if it's still there anymore. I used to say to him, can I take a load of phones into the uni and just sell them on sale or return? And it took a while to build up this trust with him. And he was like, yeah, all right, let's give it a go. Started 1, 2, and started doing a bit of that. And then that's how I got into property originally, was just doing that arbitrage of the local phone shop into the university. And then various property ventures over the years, acting for investors and doing developments for them and bits and pieces in Derbyshire, and then down in London, which was really where the fun happened of the big schemes. And then, the most random thing, I guess, was a dating app that I did called Revealer. And it was the first dating app that matched people using the voice. And we had a patent for social matching and integration using the voice. That was the exact wording of it. And we set that up with a mate of mine, Paul, who's my best mate. And he was the techie, computer guy. He built it. And I did the marketing. And then we launched it and got into all of it. We were in Time Magazine, the Daily Mail, all over these places. And we had it for about 6 months. And then one of the largest dating businesses in the world came along to us and went, oh, we quite like this. Can we, buy the trademark off you? We don't want the database, we just want the trademarks. We'd like to do it.
Yeah, right.
And we were like, well, this is quite fun. But we thought, no, we didn't have a clue what we were doing. The user base was going through the roof, like 100, 200,000 users. And Paul and I were like, what on earth are we doing? Our hosting bill was thousands a month and we couldn't afford it at the time. And we said, actually, let's just sell it. Yeah. And we got out of it. So it was like a 7-8 month journey of being involved in something that was hyper growth that I had nothing I knew about. We just totally winged it. And it was quite a funny journey, but definitely didn't sell out for any figure that anyone would imagine it was. Sure. It was more of like an enjoyable little sidecar, I guess. Anything where I see an opportunity, I'm sure, like in your career as well, Stuart and Peter, you see an angle, you see something, I'll give that a go. And worst thing that happens is you learn, and that's
100%. That's what took me into the lending game. Utilities was great for me and my family, and I worked with some fantastic people who also did really well out of our last venture. But the end, like, right, what am I going to do with this capital? I could put it in the stock market. I could go to this advisor who'll take that fee. I could go to that advisor. It's all passive stuff. But when you're wired to be hands-on, and you look at people who've really been successful around Greater Manchester, all of them have or do dabble in this space, because it's a damn sight better than what you're going to get off the bank. In my mind, it's a lot more consistent and better than stock market and funds and advisors with hefty fees, even when the fund hasn't performed. And it's a great space, and it's what took us into it. And we know we've made some mistakes, we've made some great decisions, but we've now got a platform that we love and enjoy. We're developing the team, and hopefully we'll kick on to the next stage of our evolution. So it's what that mindset's what took us into it in the first place. I remember our first phone call. I was at a kid's playground pretending I was professional, talking to Pete on the phone, and you had the experience in the space. And we just thought, you know what, with Pete's experience, I had some liquidity. We could do some great things, and we've done that with Darryl and a growing team, haven't we?
It's good though that you've got the scale there, because there's a lot that never really achieved the scale. And especially when I stepped down in June last year and I put a post on LinkedIn, the amount of people that came to me and said, we've got this much from selling this business, we've got this much liquidity, can you lend it out? One, I can't, because it non-competes and I wouldn't go against my own business, and it just doesn't work like that. And secondary, it's really hard to get money out at the moment. There's so much money out there, it's unbelievable. But to scale and get to the point you've got with the loan book you've got now, I mean, there's not many that have done that in that time scale in a competitive market either. So
I think look, if you work hard at things, it helps. Because what intrigues me is still learning every day massively in this space. We've got competitors a lot smaller than us, but have 3 times our overhead. The utility space where I'm from, you do earn your money, you work hard, you work long hours, you could definitely work a lot smarter. But we've had to graft. We've probably been a bit late with hindsight making the key appointments we've made in the business. But we look at a lot of loans to do a loan, don't we? The brokering sector, there's some flaky characters in there, isn't there, that'll waste your time presenting something to you that isn't in reality what they're telling you it is, and it's a bit insulting to your intelligence. Like, you didn't think I was going to work that out. But you've got to graft, you've got to network, doing things like this, getting the brand out there, meeting good people, understanding where they're taking their business, which hopefully we'll come on to with yourself, Guy. You've just got to put yourself out there and find those good deals, because you can find bad ones pretty easily because they come to you.
Yeah, they do.
You've
They
almost got to go
around.
and find the good ones, haven't you, and meet the strong brokers, your Arc and Co's and people like that who are just solid people who your mindset's aligned. We want to do business with you, Stuart and Pete. We're not going to do loads with you, but we'd like to place 1 or 2 loans a year with you, the right loans where you want to do business with us again in the future, and vice versa. So it's been hard graft, but it's there if you want to find it.
Yeah, well, the brand name Stamford, it comes across really well in the market, and I think that's where I first heard about you, Peter, was back then, was, got to meet this guy, this growing business, etc. And what we found in the early days of Glenhawk was it was a market where we put a brand on it, put a label on it, put a word that didn't really mean anything at the time, and a lot of it was like, what on earth's this? Who are these guys just chucking themselves out there? And as you say, get yourself out there, do things like this that others aren't doing, and it saturates across the market. Well, there's a lot that are just perfectly happy sitting there, lending the money, churning away, and they just want to keep small, keep quiet. But there are some that want to grow but don't want to put themselves out there.
Indeed.
But you really have to in this modern age. You can't just sit quietly. You need people to hear about you, because it might be a random broker in, I don't know, Exeter that hears about you and goes, I've got a brilliant deal for you down in Bristol, and you guys go, oh great, how'd you hear about us? Podcast. So more lines in the water, more fish you're going to catch is this market at the moment, I think.
100%.
And as a new lender, or as a new lender at one point, you do kind of attract somebody that might be looking for something that hasn't worked for somebody a bit more mainstream, or hasn't worked for their usual go-to. So you do end up seeing a lot of deals. We've kissed a couple of frogs. We've had some horrible interactions. It's not all plain sailing, but we've learned our lessons, and we always learn our lessons, and we don't repeat those lessons. What would you say the biggest lesson or the earliest lesson? There's two different questions. What was the biggest, and what was the earliest lessons you learnt?
Earliest lesson, I guess, was not to worry too much, because it always does work out in the end, no matter which way it goes. There's a resolution. And the first one was our first loan went into, we had an issue with him. He was a great guy though, based out of Wembley, and we lent to him, and he was doing a conversion for an upper mansard and side return. And we looked at the planning permission after we'd done the loan. And bear in mind, it was just myself and Nick sat in an office in Mayfair with some investors' money to lend out. And we sat there and like, oh God, we didn't check the planning permission. He hasn't got planning permission for it. And then the planning permission he did get was the wrong one. And we thought it was the end of the world. We thought, oh, he's going to default. What's going to happen? And, again, it was a case of learning on the job. We were underwriting off the bat, having never done it before. I haven't ever done it before. Nick had done it before, but we just missed it in the whole flurry. And I believe it was because the volume of inquiries we had in that first month was, I'm sure you guys saw this, was huge, like, billions of inquiries, of a lot of rubbish, 99% rubbish. Then these couple of gems come through. But I guess early on it was going off the person you're lending to, meeting them, looking them in the eyes, hearing about their plans, hearing what they're doing. You can understand them far quicker than a sheet of paper that comes through, because it might look terrible on paper, but you meet them and go, oh, this is a good deal, this guy knows what he's doing, he's got a plan for it. But then it's the ones you meet, and then, I don't know, you turn up and you just get a feeling about them. You go, someone actually said to me the other week that never lend to anyone that has a Lamborghini. We were talking to a few lenders, and there's nothing wrong with Lamborghinis, great cars, but they said when they turn up on site, some of them turned up in a Lamborghini and said they were always the ones that went into default. Yeah. And they said they don't know what the trend was, but it was always that. Yeah. And I said, well, yeah, who knows? But people, I guess, was one of the lessons there. And then just not worrying, because it works out and you find a solution. And then since then, we had a lot of problem loans over the years, which on the face of it, the world's falling apart, but once you get through it, resolve it, get to the other side of it, it's quite an enjoyable experience, helping the borrower out, making sure we get our capital back, and getting a resolution of it all. But always about people, always comes back to that, really.
Agreed. I'm reluctantly going to ask Stuart.
Look, you know my answer, but for the purpose of our session, it's just picking up on a few of Guy's solid points there. What really caught me by surprise, because I'd consider myself not being particularly naive, but growing up in an industry where you earn your crust by digging holes and fixing things, it's real life stuff. There's quite a few fraudsters in the space, yeah, and that really I'd never underwritten a loan, thought I could do anything. Why can't I? I've been part of building this business and sold it, and we've all done really well. We were had over right at the start on a couple of loans by a guy who, he knew the space, we didn't. He knew where to hide his problems. We were quite naive, we were giddy, we wanted to get capital deployed. And it was a real steep learning curve. So you've absolutely hit the nail on the head. For me now, if we get one that could have problems, like we were looking at one down south, I can't name it because he'll kick me because you're not allowed. I didn't like something about it. There were structural issues in the property, etc. And we sent our sort of in-house monitoring surveyor, just go and meet this guy on site and get him to bring to life to you how he is going to build this for that money with those structural issues. Because at face value, I hated it. Anyway, we've got ourselves comfortable with it because we've gone and met him. He drove him round the corner in his van, not his Lambo, to a couple of sites where we'd done virtually the same thing. Right. Showed him the price point, and we've got ourselves comfortable with it because we've got to know and meet them. Because you're right, the right people, you hit a block. We've had a loan down in Shepherd's Bush. A lot of people didn't like it. Loads of structural complications. And between us, the PM, and the borrower, a lovely family, professional people, we found our way through 3 or 4 obstacles there, and it's gone well for them, well for us. We've needed some additional security at times to get us comfortable. They've provided it. And so often your Lamborghini driver will turn up, say, okay, can we have a look at your assets and liability schedule? Your net worth is 0, but you're driving a Lambo. I'm not feeling
bit
this
too
one.
stretched some of the time.
So look, I mean, it's repeating everything Guy said in our own words, isn't it? It's been an intriguing journey in that regard. But you for every bad one, you meet a phenomenal human being.
Yeah, there is. You
know, the family we lent in and around Muswell Hill, Crouch End down there. We've done 2 loans there. They've both been great. Been dead open and honest. They were naive. It was their first development job. It was in the earlier days of our business a couple of years ago, and if people tell you the truth and you can't half find a way through a problem, can't you? It's exactly. When they're dishonest, they're trying to hide things, and then it saps your confidence. And I remember at the start, the one we had that went wrong over in Hull or wherever it was, I was lying awake at night thinking, what have I done? Why didn't I just give the money to the bank and let them invest it? And it does, but you realise, you know what, for every one of them, there'll be 2 absolute amazing loans that go really great well. And they're a repeat customer, they become a friend. You've got to step back from the emotion of it really and run it as a business. But what a journey, and I'm sure you've probably got 10 of those stories. There's
some brilliant ones. I mean, the key lesson for me on that, though, on the honesty side and dealing with the people, was whenever a loan went into receivership or looked like it was going to go into default, the ones that called you up straight away and said, look, I need help, can you help me? Brilliant. We'd work with them. They were open sheet on the table. Come and sit down with us, say, look, I'm refinancing this, refinancing that. Then brilliant. But it's the ones that buried their head in the sand, wouldn't answer the phone, started sending, threatening emails. One time a guy to my door of my home, which was pretty crazy. Are the ones that were always the ones you think, God, we shouldn't have lent to that person. And you look back on their history of where they've gone now, and you see they've gone up, they're in the newspapers for the wrong reasons or something. You think, I knew they were a bad actor. They were a wrong un. And you just had that feeling about them. But the ones that are open book, you're like, I'll help you. Look, I don't want to take your property off you at all. We want to lend to you again. We want to help 100%. You. And usually there's a reason it's happened. Something's overrun, a refinance has been delayed, and they need a bit of help from you. And we want to help. We're not a loan-to-own lender. And there are a lot of bridge lenders over the years that have set up as that. They look at the asset and they go, actually, I quite like to own that. Don't want to operate like that. Because as soon as the brokers know you operate like that, you're going to destroy the client. No, don't want it.
100%. It's like he's read our loan book, isn't it?
But you guys had a coffee beforehand.
It feels like it. But you're right, you don't. And a lot of our peers that we look to for a bit of advice, because they're 10, 15, 20 years in the space, they go into it thinking, well, if it goes well, great. If it doesn't, well, we'll take it. Who wants to, we've ended up owning a care home
Operating or trading game,
absolute last resort, and it will go well for us. But if those guys had just been upfront and honest at the start, it'd have been a good loan for us and a great business for them. It's just intriguing how they almost put more effort into doing it wrong than doing it right, if you know what I mean. And I find that really weird. And we've got one at the minute where the guy did have a checkered history. The loan was great, the security was great, but God, he makes things hard work. But really, with hindsight, he was always going to. Then we've got others where they've had issues. You sit down with them, they bring to life the context around why that issue presented itself and why that business wasn't good. You think, you know what? I can work with this guy or this girl. We'll be all right here, and more times than not, you are.
No, you're right. You've got to have a heart in a lot of the situations.
Indeed.
I mean, ultimately, everyone is a human being as well, aren't they?
Yeah, completely.
However they act, they are still a person.
And look, you'll take a haircut, right? Look, we've done all right out of it. I don't need it all. I don't want your house.
Yeah, that's it.
But you get it on the market and get it sold.
That's it.
And we'll stop piling on default interest or whatever it is.
And get it
done. We'll give you 3 or 4 months, but get it sold at a sensible price. Stop believing it's worth this because it isn't.
It just sticks on the market. We had recently actually a guy on that point of helping him out. He was the first ever PG we called on in all of the $3 billion we'd had out the door. And we approached them and said, look, there's a shortfall on the asset, etc. And he was open book, straight to us, said, here you go, this is my position, this is what I can do, etc. And we struck a deal with him, which was essentially, look, just the capital and the interest, let's just leave it. Because he'd come to us and say he was so honest in the way he'd approached it and everything on the table. So that's really good. So there's some great borrowers out there, as you say. It's just the ones that, and there's plenty of them that give you a bad run, but then they get a reputation because the lending market's so small. Lenders speak to each other, brokers speak to each other and say, oh, watch out on that, and we've been stung by on paper guys that there's one guy that had Schumacher's Formula One car, and he's quite a well-known guy, I won't name him, but then we got hugely stung by him on a deal, and he ended up going bankrupt, that guy. So on paper at the start you can have a really strong client, but then suddenly they can turn and change things around, and you've got to be careful.
That is a really interesting point, because as you've said there, the lending market is a fairly small place, but we do have new entrants almost weekly at the minute. So all of these new lenders that are entering the market are attractive to potentially slightly quirky propositions or propositions with not pure intentions, should I say. What would you say is the hardest part of being a new lender? Where are new lenders struggling the most?
You've got to understand real estate. So if you're a new lender setting up, first part is you've got to understand real estate. Whatever angle your setup is, you need to understand it from a perspective of owning it, experiencing it, and having scaled a successful business before. You need that within it. But the other major part is the capital piece, because you get a lot of family offices will want to set up new lenders, and they'll go, oh, we want to get 40 million out the door this year, but these are our parameters for it. This is the yield we want, etc. And the cash they have doesn't match up with the assets that are available, the loans in the market. So there can be a real mismatch there. But certainly it's about having that understanding experience. Because as I say, last year, the amount of people that came to me and just said, look, I've got this liquidity, can you lend it out? And it was a case of they wanted to set something up themselves, but they didn't want to do it. They didn't have any real estate experience at all. They're either from software or sectors totally unrelated to what we're doing. At least utilities. That's you've got that core experience there. But it's a hard thing. It's an easy thing to get wrong, that's for sure. You can't just put money behind it and it'll work. You have to understand what you're lending on from day one, otherwise it'll just go completely wrong.
It resonates with our journey, doesn't it? The first couple of loans became problematic because of that naivety, no underwriting experience, as you touched on. We're actually just appointed our first experienced underwriter. Because look, 4 years in, we're not great at this. We have a view, but it's you've got to have your wits about you. You can't be giddy. Like we've got some further liquidity coming into the business this year. Right, what we need to do here is just sit that somewhere where it's making a return and let it evolve into the market. We can't force it out there, because if you're forcing it into the market, you're creating problems 18, 24 months down the line, because you'll be doing loans that in the cold light of day with 4 years experience at our end, a lot more at yours, you wouldn't do them in normal circumstances, wouldn't you? And we have great debates now with our process. We'll get to Pete always wants to do a loan. He's a loan junkie. He loves it, but it's in his DNA. I've become a bit more cynical 4 years in. And that's where we had the conversation on last. Pete, I don't like it for these reasons. Pete explained this position right. The middle ground is we need to eyeball the guy on site. We need to understand how he's got the capability to do that, and he nailed it. We just said we're going to come down, see you, bring to life to us with context and evidence how you can do that, and he did. And actually, I'd have a pint with you. You're all right. You're a straight guy. You've been open and honest with us. He touched on mistakes he's made, because a lot of people in this space are the perfect, aren't they? They've never made a mistake. I do it differently because of this. Well, I'm sorry, but I've done a bit of building myself, and we all make mistakes.
Yeah, definitely, and it's you know, almost going counter to my own advice there. My own thoughts was early in those early days of the business. We made loads of mistakes and still did get as we got bigger and bigger. And on that liquidity point, we had times where we take on a huge investment bank line. You know, you have to fulfil it because of the non-utilisation fees and negative carry on the business. And you go, right, let's fill our boots of lending, right, up the LTVs. And the LTV, that's my biggest learning, is the ultimate protection, because every time there was an issue where there was potential of capital or an interest loss, it was, we were at 75, or we were a bit too high on that commercial asset, or, you know, the market dipped slightly and it knocked us out. And sometimes you've got so much liquidity, and especially when the market's competitive, and it was competitive when we were doing it, it's even more competitive now. The temptation to just open the gates and go on, let's go for it. But in hindsight, I'd go back and go, smaller team, you know, be steadier on the ramp up. And just always that LTV is like your ultimate fallback when you need to drop it into auction or
100%. I think we did one maybe a year ago now. Time flies in this game, doesn't it? Down in London, and we got ourselves comfortable. It's worth this. We're lending here. The LTV strong, but that market, in my view, the last 18, 24 months has dipped more than a lot of owners down there are willing to accept. You only need to go on Rightmove and search within an area, and they've all been on there a long time, and they're all reduced once or twice. So we'll get out of that with capital and a bit of interest, not all the interest we should have accrued, but you know, that's where the protection comes in, because the market does have its issues. Look at Dubai now. I mean, 5 months ago, what a place to put your money, in my opinion. But we're in an unknown now, aren't we? The constant journey of increasing volume of sales has dropped off naturally, because everyone's like, well, what do we do here? There's missiles in the sky. It's not the sort of place I want to deploy my money. So you've got to be able to ride them out. And the one, you know, when we go back to our initial conversations with the guys together, they used to just reiterate that all the time. Your loan to value, never go over it. They've got the t-shirt, haven't they? They've lived all the ups and downs for however many years, and we're just experiencing those cycles now, aren't we? And that one, it'd be an all right loan. It won't be as good as it should be, because the market's hit into our
who would have thought though that prime central London would? I've seen some things roll back 50%. In Kensington, you're seeing decent flats now that were trading at 1,700 a foot now down at 1,000 a foot, and that's Fulham prices. Well, Fulham's rolled off a bit as well, and you think this is unbelievable.
It's unbelievable.
London will come back. It always historically does come back. It's the best legal system in the world. There's still loads to do there. It's got a bit of crime, but every major city you go to these days, Barcelona, I had my phone pinched 2 years ago. Took it off me, didn't even notice it. You know, it happens, and you just have to accept that. But I guess on the Dubai point, that's a really interesting one, because you do think, how long will that go on for from a real estate perspective? What's the true value? Because I believe you're not allowed to say value's dropped over there, or there's certain restrictions, so an estate agent can't say it's a distressed sale or it's dropped. I mean, someone will probably correct me on that.
And I think you're right, but they'd be protective of the message that comes out. 100% they would,
And the risk there is, you know, is there people in Iran that will just keep firing these Shahed 2 drones out for the next decade, or are they going to stop? Or I guess it's an unknown, isn't it? But yeah, as you say, it was a great place to park cash, and it still could be. But
look at recessions, look at the credit crunch, look at COVID.
Yeah.
Well, it recovers, doesn't
Comes
it?
back, yeah.
And I've no doubt it will, in the long term, find its solution. Like I'm with you, London will bounce back. In fact, if you were liquid enough and you were minded to have a place there, and you know the right receivers or whatever, now would be the time to buy someone's distress, wouldn't it? If you were minded to.
Or even just anything that's on the market. It's just it just sits there and sits there. And you think, this is unbelievable. Why is it so cheap?
Yes.
And I'm saying to the wife, look at the prices on this. It's just incredible.
Crazy.
And but it will. There'll be a turning point. And the last cycle I think I saw was 17, 18 when it was a big dip. I think it was around then. And it was that time when, if you had the liquidity, you go out, fill your boots, rent them out, wait 5 years, refurbish them, put them back in the market, and then do well. But I think people are just starting to see that now and calling the floor and going, let's go for it.
Look, I think there's probably a bigger debate down there around second homes and the taxation structure around it in the UK.
Yeah.
It's very restrictive, I think, if you want to buy a good asset in town, because it's costly, isn't it? And you've got to factor that into to your ultimate return, going through the scenario of try and catch the market on the up and renovate it and whatever. You've got a fair lump of cost you've got to recover out of doing that.
Oh yeah.
They need to fix that. I'm not quite sure they will without getting into a political debate.
Exactly.
But that would be one factor that it just does concern me about the UK full stop at the moment. I don't see a plan to stimulate anything like that.
No, not at the moment. I mean, the smaller stock, for those areas from 700,000 to like 3 million is the national market. So that trades pretty well. And you've always got those costs on top of the purchase and the drag and everything. But and above that, it's an international market. And I think that's mainly where it's just been a bit hit at the moment. There's still Russians there, but there's more, Ukrainians have come over to fill that void to a degree. But it's it's a whole other podcast, isn't it? On real estate taxation here.
Indeed,
how do you get it all moving again?
No.
Well, that was a very convoluted but actually quite good answer to how lenders are going to struggle starting now. With all of the various complexities that are going on internationally now, how do lenders scale well? Where do you see opportunities for scale?
I mean, you've got product diversification, quirky structuring of deals. I guess then it comes down to the flexibility of the lender, but then you don't want to push yourself too far, because then ultimately you need to have your protections in place and your risk parameters. But I believe in the UK, as we discussed earlier, having a good brand in this space now, getting your name out there, understanding the people, saturating, like Colin's done with Project & Co. He gets his name and his face everywhere, and he's got a really successful business now.
And we all smile when we hear the name, don't we? Because he's just an infectious guy.
And he is a lovely guy, and they've built a great business there. And there are a lot of people that, as he openly says, dislike him because he's been successful in a space that is inherently, shirt, tie, very formal, very structured. And I believe it's a little bit like this sector, and I think your business as well. You're doing things differently. There's a great reputation out there on the street, and I hear about it a lot. And that's the way you're going to differentiate yourself, because no one's going to go to 100% LTV for to win business. No one's going to floor their rates too far, because everybody needs to get a yield. So it is very hard to have a USP in the market. And there are some saying let's automate the lending system, but it's very hard to automate a bridge lending business. You can do it, AVMs, your legals a little bit, but it comes back to meeting the borrower, looking them in the eyes. Do you trust them? Is this going to be a good deal? You can't get Claude or GPT to do that for you.
No, you can't. Look, I think you can use AI or whatever to streamline the sort of legal process, the conveyancing and all that, which, I mean, it must drive you to drink, Pete. It really must get you on the phone. I don't know how he's got the patience for it. But going back to your question, obviously we got into it with our own capital, and I never quite understood how you would get into it with institutional money. But because I'm not from the space, we had a great meeting with Michael at MS months ago, didn't we? And it was great to understand his journey, because he came into it with however many years experience from leaving school as he did into a big business, a little bit like me in my 10 years in the utilities sector working for a bigger company. He learned it. He thought, you know what, I'm going to have a do at this. He lined up his institutional funding. He cracked on with it, and wow, what a business he's created. I could never have done that. We could never have done that because I didn't have the experience. But now we built it off of using our own capital, and really interested to hear about what you're doing next and the funding that brings into the space. We're well up for that institutional money if we want to go from 200 onwards, because we can do deals with our own money, then retrospectively tap into the institutional line, so we can react, because we pride ourselves and look, if we say we're going to do it, it's because we actually want to do it, and the money sat there and it, to a large extent, costing us, it's burning a hole in our pocket. We can still be quick, but then if we need further liquidity to keep kicking on, we can go and retrospectively tap into it, and I think that's probably on the horizon for us over the next year. So it's great to hear what you're bringing to the market moving forward, which you might take us to there next, Pete. I'm not quite sure, because it gives you so much flexibility.
Yeah, it does. I don't know where you want to go next, Pete, with it.
Well, it's probably a good time to discuss it, isn't it? I mean, you're talking about how we differentiate between lenders. You're also in the same debate in your own head, I guess. How do I differentiate from an institutional lender? And you've pivoted slightly from lending to borrowers to lending to lenders.
I mean, again, coming back to the points earlier, I saw an opportunity that in the UK there are a lot of wholesale lenders out there that will do advanced rate structures, warehouse-based structures, and will allow you to work your capital more efficiently, get a better return, and place it where else you want on different assets. But in that space, there's a lot of competition. There's so many doing it. From my experience, I think I raised 9 or 10 different warehouse lines across. JP Morgan, we were their first European bridge lending warehouse structure, which was a great experience working with them. A guy called Rob Tanner Smith, who, look him up on LinkedIn, he's brilliant in the bridge lending space. Recommend meeting him. He knows everything about bridge lending, and we had a great journey with him when I think we had about 300 million from them at the time. And BNP Paribas, Nomura, Bearings,
big names.
NatWest Markets is the investment bank of NatWest Markets is one of the biggest funders at the moment of Glenhawk, and it's finding the right relationship, because you want to sit down with these guys and go, right, similar to when you're lending, you want to, when the shit hits the fan, can I sit down with them and go, look, let's work together? Because there have been times when we've breached covenants, we've gone over on credit, a loan's gone into default, we couldn't buy it back at the time, and it's sitting down with the banks and going, look, can you help us? And I've had a few that I could name that they were awful to deal with, and they would be super aggressive straight away, and it would just destroy the relationship. And you think, well, I'm just going to refinance you in a year or so now because I don't want to work with you. So the warehouse market, really competitive, loads of great people out there doing it, several interesting ones as well, which can run by those. But then on our side, there was the gap for the whole loan purchasing. So we found there were families who had funded their loan books with their personal liquidity that wanted to release some of that liquidity and go, I don't know, 100 million book, I want to take 20 million out for whatever reason. There's an equity release sort of product, so we'll come in, buy the loan out, the lender will keep servicing the loan, and we'll just sit it on our balance sheet in an SPV, so the borrower doesn't know it's our loan as such. So that's that one product. So you've either got too much liquidity in the business, or you run quite equity light, and you want to originate loans in the 0.8 a month sort of space. That's the other area we can help in as well. So our product sits in a nice space, really. It's not a warehouse product, it's loan by loan. We take it out, anything over and above our floor interest rate the lender earns, and it's quite a straightforward, simple product. And I created it because in the UK at the moment you've got two of the parties that are doing it, and they're American funds, and they do it really well. One's got 1.5 billion live in the market, the other one's got 1 billion, but there isn't a homegrown platform like ours that is doing this. So it's quite an interesting product, because I get to go out and the lender packages the deal up and sends it to us. So the underwrite on our side is relatively light touch. We just get the best bits and go, well, this looks good, looks nice.
We're comfortable with
we're comfortable with it. We get it because the lenders do all the hard work on it, and then for us it's just an oversight. So it's a lean business in terms of costs and people, which is what I wanted to do this time round. Yes, it's a thinner margin than a lender, but we're a volume-based business. So the idea is to build it up to a billion under management over the next 5 years, which I think with the state of the market and the demand that we've seen is quite achievable. So yeah, for some it fits. There's two different ways of using it really. So quite an exciting time.
No, I'd suggest so. Pete was talking me through it yesterday ahead of us meeting up today for the first time and having this chat. And look, I think there's definitely a space there for it. We would find it attractive, and I know others who would. So yeah, looking forward to it launching, if you will, because we'll be at the front of the queue saying, okay, can we have a chat? This is what works for us. Does that fit with you? And it can help us take the further steps we want to take over the next few years.
Well, it's certainly a nice piece of liquidity, because we actually had forward flow funding or whole loan purchase funding at Glenhawk at one point, even when the book was at 300, 400. And it was a great sidecar that you could go, oh, we're over on that covenant. Can we move it to there? Can we rebalance it out? Oh, we can't do that deal. Oh, but it fits in that line. And it's quite nice. It's a good way to do it. So there was always a need, whether you're big or small. There was always a liquidity problem you couldn't solve at some point.
No, I agree, because I think the one big learning point for Daryl and I, we never get Daryl to these, do we? Unfortunately, but
was Daryl in the utilities business?
He was commercial director of two businesses I was involved in with me, and he had his equity slice and did really well. He's come into this and he sits in the background, and really he runs a business with Pete day to day. What we really took some getting used to is we are just permanently juggling liquidity. We don't want to be sat on cash. Drawdowns come in, you need to fund them because your word is your bond, and your obligation. You've got loans you see that you like, but you've got no liquidity, and then lo and behold, when you've got liquidity, you can't see any loans that you like. So having that ability to tap in and out of a facility at a point in time with the right commercial structure for both parties lets us overcome that, because you'd be scratching your heads. We've done all right, we've got a few quid, we've got it deployed, we've got no cash. And then 2 weeks later, a loan repays 6 months early you weren't expecting, and you've got loads of cash sat there.
That's it.
It's took some real getting used to for us. Sleepless nights, we'd just be like, you'd be looking at it every day. It was crazy.
It's hard to balance it. And when you get bigger, you get more redemptions.
Indeed.
So you do a month of 50x million, and then suddenly the next month 60 redeems. You're like, oh bloody hell, where did that come from? Didn't expect that to happen.
No. It's a lot of work to stand still, isn't it?
It is, and you end up just a hamster wheel of lending, and it's like an addiction. You're like, I get the money. You're looking at the net book growth every month, like, oh, we've got to grow it by 5 million this month, got to grow it by that, and then damn, we slip backwards, and it becomes like like a casino sort of thing where you're like, come on, let's just grow it. But that's where the beasts like Together and West One have really done well, because they originate strongly every month. I think Together does something like 150 million a month of bridge lending, and West One as well at the moment, and that's a huge volume they're doing in the market. But they've just done it well, and it's balancing that liquidity, and too much money one month, not enough the next month. And we've been there, had all that journey. Even when you're fully funded, there's usually a pinch that comes up. Oh, what now?
But like you can't take it. You can't let it worry you, because you'll find a way through.
There's always a way. There is always a way.
We had one that redeemed last week. It should have been redeeming for months. It's been a great loan. If we look at what we lent and what we've had back in return, it became more problematic than it should have because of the individual we lent to. And you're glad to close it out, but then at the same time, when you get the money back, you're like, that way, I actually didn't really want it back, because ultimately it's performed great. It was making great money every month, and we had a bit more runway. But sometimes all good things come to an end, don't they?
Yeah. Well, we had a loan like that on the Wentworth estate, and it was, what did we lend? 10 million on 28 million on a phenomenal house, and he was just finishing it. And he was putting the garages in that were the right depth for the Rolls-Royce Phantom extended wheelbases that you put in, etc., etc. And we had that loan for about a year on the books, and then he redeemed us, and he went, oh, I'm going with term financing. We're like, yeah, fine, cheaper money, it's the way to do it. And then recently I saw that that lender had taken the property back, and it's for fire sale, I think, for about 14 million at the moment. And it almost halved in value. And you think, what on earth has gone wrong there? And it's one of those loans where you'd have been happy if he'd have said, oh, can I extend with you? And frankly, we were too expensive for the guy. But then he went with a challenger bank, and then it's on the market now. So,
but you know what?
It's a real shame.
But when you look at the asset in isolation of your loan, it looks weird. But sometimes when you stare through these A&Ls and your Lamborghini drivers, and you're in a meeting, and look, I'm not into watches, I haven't, but you look at it and think, I'm sure that watch is a couple of £100,000. And you look at their A&L, you're like, well, you don't have that much equity in there, because I know that business and it ain't worth that. And you look at this property and you Google it, and sometimes the way people live, it just intrigues me. I've never had any debt in my life. I don't understand it. I was brought up, and if you want a new TV or a sofa, you need to work hard, put the money away before you buy it. You do see some weird and wonderful people living these exotic lifestyles that ultimately they come crashing down, don't they? It's been the strangest thing for me to get used to. It really has, because they'll rock up full of bravado, full of confidence, and you're like, your A&L tells me your net position is this. I view it as zero, so I won't bank on ever calling on that PG in a doomsday scenario. I'm just looking at that asset in isolation, and you've done that and done well. Well, whoever's coming after you hasn't, have they, for whatever reason.
But that's interesting you say about the watch, because on MFS, the big collapse that happened recently, and it was in the paper yesterday. They said he was in the FT that his wife had 406 million allegedly moved to her bank account in Dubai from the UK. And one of the investment banks that nearly did the deal with them on refinancing a few years ago, I was with them the other week and sat with their head of Europe, and he says, you know what put us off? It was the fact he had like a 700 grand Richard Mille on, but his house at the time was worth, I think, about 450 or something. And they were like, well, that's what put us off. Was we looked at the watch, and one of the guys, the analyst, went, you know what that is? Why is he wearing that? And it didn't match up. And then they didn't do the financing. And then ultimately the one that did is on the line for a significant loss at the moment. So, but then that is obviously a different conversation, isn't it? That whole fraud.
It's an interesting conversation, actually, because it ties into the timing of your startup as well.
Yeah.
Does that inadvertently play into your hands, the market turmoil around?
Yeah, sort of. I'd say broadly positive. It's delayed the proper launch a little bit, because the fund that's coming in to back it, they're one of the top 5 asset managers in the world by assets that they have. They're clearly, more cautious on the market. They're more, more diligence needs to be done in understanding the lender, what the lender does from a KYC and AML perspective on the underlying borrower, which lawyers are used, which valuers are used, because they're all the weak points that have been exposed now. It's that double pledging of assets that MFS were doing. I say allegedly again, in case any of this comes back in the future.
We don't know.
You don't know, but from what you're reading in the news, it is alleged. And that double pledging of the assets was one part of it. Then you've got the bent lawyers, you've got the bent valuers, not Colin, just to clarify. And it was that whole structure. So every lender, every senior lender at the moment is going back through the loan books of businesses they've lent to and gone,
makes sense.
How can we ensure this doesn't happen? We need more audit rights in place. We want to understand your structures, etc. So for me, that's been quite good, because a lot of lenders have come to me and said, can you help us with our financing? They might not want a warehouse anymore. They might think, well, actually, I'd rather just do it loan by loan and find capital elsewhere. Others are doubling down on warehouses and doing bigger volumes through it. So yeah, I'd say broadly it has helped. Slower diligence on the funding of us on our side, but then down to the underlying lenders, there's a lot of positivity there and some really interesting conversations, because some have come to me and openly said, they want so much more compliance and procedure in place. I don't know what to do, Guy. You know what, it was going to happen at some point. And the ones that are already doing it, that understand compliance and do it properly, will win through and will grow out of this. So in many ways it will shrink the market but allow more deals into the market, but I think which is needed.
You make a lot of good points there, but if you go back to we had no governance at the start, we've now probably got too much. We need to find a middle ground.
There's a balance,
because the right governance it weeds out the problem borrowers, doesn't it? It weeds out the people who aren't telling you the truth. So there's a balance there. But what intrigues me with MFS is it they've put that much effort into creating that pyramid and that scam. They'd have had a pretty decent business if they'd have just channeled that effort into doing it properly. Granted, he wouldn't have been able to sail off to Dubai with whatever the sum of money allegedly is, but it just intrigues me that why would you set about creating that when you could just channel it more positively and have a decent, sustainable, honest opportunity.
And obviously there's so many people affected by the decisions that were made there. There's some amazing staff, there's some amazing people in the industry that have, and it's not even just MFS, obviously it's the businesses that were also funded by MFS. So there's a lot of people affected by that. I think it's probably a good time, as we start to wind up, to say if you were in that position and you had to start from scratch, or you had to go right back to the beginning of your journey, what advice would you give yourself or to people that are starting that journey again now?
Starting a bridge lender from scratch.
Or starting in the market. Yeah.
Probably don't do it. Not at the moment. I guess just do it. It's the product itself. Security on an asset is really simple. It's there's the asset, that's it. But what goes on behind it is the diligence. If you were to go out and just put a mortgage on a property, easy, anyone can do that. But it's the background work behind it. So it all comes back to that underlying theme we've all agreed on, is understanding your borrower, understand their background, and just build slowly. That would be my lesson again, would just be go out, build it gently, don't rush like I was doing in the early days. The market will come to you, the reputation will come to you. You're not going to build £1 billion book overnight. It takes a long time, and in bridging, I would say, is actually, I don't think much is impossible, but yeah, it's very hard to do that these days when you're up against some of the huge businesses that are out there. But get it to a size that's reasonable and comfortable, and enjoy it as well, because it's a great sector. There's a huge amount of money in it, but there's not that many people. Everybody seems to know each other. It's a real community spirit, and there's a lot of fantastic people in it. So yeah, I'd say just do it, enjoy it, find something that differentiates yourself from the market. Maybe in your product, maybe in your people, maybe in your approach, like how Stamford's doing it with the podcast and the people you have involved. And then just see what happens. What's the worst that can happen? You learn from it. You're not gonna die, hopefully.
No, indeed.
Great advice.
But I'm sure Stuart's got better advice than me.
Well, you know what? I wouldn't say I do. I think from my perspective, looking at our 4-year journey and getting into the space new, people are everything. Your monitoring needs to be strong. I haven't met, other than Colin, a monitoring surveyor that I necessarily trust fully. We've had some problems. We've got some ongoing problems with them. So, your underwriting is absolutely critical, because you think the property market. And I came from a utility space, and I tell myself I'm a builder and developer, and trust me, my accountant will tell me I'm not. So get those skill sets around you that you don't have, and take your time. Now that's easier said than done, because you might be borrowing money that's costing you money that you want to get deployed, but you can never rush money out the door in this market, because you're just increasing your problematic back book in a year or 2 years time, aren't you? So reiterating a lot of what you've said, but I think the people and being mature enough to say, right, I'm good at this part of the pie, I need to fill that part with people who are good at their bits, and then between us, if we communicate and we work hard and we're open and honest and we're out there. I mean, look, this was never my comfort zone doing this. I would never have done this in my previous life. But you've got to do something different and keep up with the times. And I think if you can keep it simple, the legalities that go into doing a loan are way too complex for what is actually quite simple.
Sure.
Then you'll find your way 100%. Yeah. Oh, fantastic. Amazing. Well, thank you both very much for joining us today. It's really great to have you, and great to hear your insights again.
Enjoyed it. Thanks for having me.
Thank you.